Good morning, everybody. A very warm welcome and thanks all for joining our first earnings call post-listing. On this call, we are joined by our joint MD, Pankaj Rathod and Gaurav Rathod, along with our CFO, Mr. Atul Parolia. The results and presentation are uploaded on the stock exchange and the company website. I hope everybody has a chance to look at it. We are happy to witness a healthy response to our IPO. We want to express our gratitude to all our shareholders for entrusting their confidence in us. We would like to congratulate everyone associated with our company, including employees, customers, business partners, and bankers. During the H1 FY24, our company has achieved a revenue of 961 crores, EBITDA of 244 crores, and a PAT of 169 crores. EBITDA margin stood at a healthy 25.4%. This performance is backed by volume growth and improvement in product mix. With this brief, I would like to hand over Pankaj Rathod to take this further.
Thank you and good morning, everyone. I will give a quick synopsis of our journey so far. Cello World was incorporated in 2018. However, the roots of the promoter family in this line of business go back to 1960s. Over the first 6 decades horizon, the promoter family diversified product range and brand portfolio. All the consumer facing owned by the promoter group have been consolidated under the Cello World Limited prior to the IPO. The wealth of the experience has given us a very deep understanding on the Indian consumer preference and needs. We have curated an extensive product portfolio that caters to a diverse range of consumer requirements and offer a broad range of contemporary products across different ranges, types, material and price points. Our key brands, including Cello, Uno Max, and the respective logos are registered in the name of Cello Plastic Industrial Works, a member of the promoter group, CPIW, has granted a company an exclusive worldwide sub-licensable licensee to use these brand names. This license is valid for 20 years and auto-renewable after this term. Further, this is no royalty or brand payment done by Cello World for users of the brand name. With this, I will hand over Gaurav Rathod to talk about business and growth strategy.
Thank you and good morning, everyone. Just to talk about the business, I'll give you a synopsis of the business and the strategies for further growth. So our product portfolio can broadly be categorized in 3 verticals. All our businesses are consumer facing, but we operate our businesses as 3 key verticals, namely consumer wear, writing instruments, and molded furniture. Within these verticals, we manufacture varied products such as insulated bottles, dinnerware, pens and stationery, storage containers, glassware, and other products. We manufacture our products at our 13 state-of-the-art manufacturing facilities, which are located in Daman, Baddi, Haridwar, Kolkata, and Chennai. Further, we are adding another location in Rajasthan, which will take care of our future expansion across product lines for the next 5 to 6 years. 80% of our revenues come from these manufacturing units. In terms of channel-wise revenue distribution, general trade is the backbone of our distribution network, and it is well complemented by modern trade, online, and exports. Leveraging our strong brand recall, manufacturing capabilities, vast distribution network over the years, we have grown our revenues and PAT at a healthy CAGR. The resilience of our business model is evident in the growth that we saw even during the pandemic. Going forward, we are committed to scale this brand to new heights. We continue to churn out new and innovative products every year. We have launched various products in the first half of 24. We have given a snapshot of these in our presentation. The company is also setting up a greenfield soda line glass unit in Rajasthan, which will be operational by March of 2024. This will be one-of-its-kind facility, manufacturing various products like tumblers and storage containers, to name a few, further enhancing the diverse range of products that the company offers. For this plant, we have earmarked a capex of rupees 200 crores. On the writing instrument side of the business, our base is currently small, and as we cover only 55% of India's geography, so there is ample room for growth. Also, currently our portfolio consists mainly of ball and gel pens. Going forward, we will be adding other related stationery items. In the molded furniture vertical, there is a lot of unorganized competition. So our strategy has been to add more value-added products to our product mix. We have already started this process, and today 13% of our business comes from these products. Going forward, we aim to enhance this number even further. Thank you, and I would like to hand it over again to our CMD, Mr. Pradeep.
Before I give you the synopsis of our financial performance, I would like to highlight that this entity is a culmination of all our consumer wear business of the promoter group. A group restructuring was undertaken through a series of business combinations under control to consolidate the business under our company. However, all the financials for historical years have been restated and are fully comparable. Due to paucity of time, we have taken an exemption for present Q2 FY23 numbers. We have already started work in the front and will be able to give all the comparable figures in the future. Talking about our Q2 performance, we recorded a top line of 489 crores. Gross profit stood at 261 crores with a 53.4% gross profit margin on a consolidated basis. EBITDA came in at 120 crores with a 24.6% EBITDA margin. During the quarter, PAT was at rupees 87 crores with a 17.7% PAT margin. Coming to our H1 FY24 performance, we have registered a top line of 961 crores, of which 66% came from our consumer wear, 17% from our writing instrument, and the remaining 17% from molded furniture and allied products. Gross profit stood at 509 crores with a 53% margin. Consumer wear garnered GP of 53%. Writing instrument GP margin was at 58.5%. Molded furniture and allied products has a GP of 45%. EBITDA came in at 244 crores with a 25.4% margin. EBITDA margin profile across verticals is also very healthy. PAT margin of 169 crores with a margin of 17.6%. On the consolidated basis, the company grew at 9% for H1 and H2. Though volume growth stands at 13%, the value growth was lower due to the softening of raw material and energy prices, which are the key raw materials for two of our major verticals. And even because of the plastic raw material going down substantially, there was a correction in price in some of our verticals. Also, number seems lower as the Diwali festival season shifted from October to November, and the key sales month became October. So the Q3 would be much more healthier when we see in the coming quarters. Though in the first half of 24, the consumer demand was not at the robust level and it was a little muted, but we are seeing a strong demand coming up. Post October, we saw a very good month, and I think the second half of the year would be much more robust. The profit margin has stood at around 20% growth in the first half. In terms of the balance sheet and the key metrics, I would like Mr. Atul Murali, our CFO, to highlight on this.
Yeah, good morning to all. See, with regard to key balance sheet and cash flow related metrics, working capital days as on 30th September 2023 stood at 159 days as compared to 154 days as on 31st March 2023. Cash flow from operations for H1 FY24 stood at healthy rupee 105 crore. OCF to EBITDA stood at 43%. Cash and cash equivalent stood at 53 crore as on 30th September 2023. Capex during H1 FY24 was 107 crore. This year we expect to do a total capex of 225 crore. We have a track record of very healthy OCF EBITDA conversion of past 3 financial years, and this H1 period was no different. In fact, we sweat our assets more, the return ratio will continue to be healthy. The growth opportunity ahead of us is vast, and with such a strong cash flow and healthy balance sheet, we are very well placed to capture upcoming opportunities. Please note that in our presentation slide 20, sales figure of consumer glassware and writing instruments should be read as rupees in million instead of rupee in crore. With this, we conclude our presentation and open the floor for question and answers.
Thank you very much. We will now begin the question and answer session. The first question is from the line of Percy from IIFL. Please go ahead.
Hi, sir. My first question is on the appliances business, the coolers business that you have recently launched. Can you give some idea on that? What are your plans here? Do you plan to enter any other type of appliances also? And why do you think that you can win in this market? I mean, because there are so many other players in the household appliances market. What is, apart from the plastic being used, what is the commonality with the rest of your business? Yeah, that's it from me. First question.
Right. So, we are only into the niche areas and we are only into kitchen appliances. So, we are trying to take mixers, induction cooker, kettles, cookware, which are restricted to the kitchen. And why, though it is a crowded place, definitely Cello as a brand and what the consumer are key retail is the same, and even our target audience who purchases this are mostly women, and they have been buying Cello products for various years on other casseroles to lunch carriers and everything, because he's the decision maker. So we are getting good response, and we will only restrict and we will be in the niche area of this. We do not want to enter completely in the crowded area. So we are just creating a niche market of a small portfolio, not very large portfolio. It will be a medium portfolio what we want to create.
So, sir, regarding this air coolers that you have recently entered, any comments on that?
No, air coolers we have launched much earlier. It was in fact 5 years before COVID, 5 to 6 years back. And the air cooler, we did not get a very good response because I think so, this year we are scaling it up again in Venplast, because that's a vertical which is in Venplast Limited, one of our subsidiaries now. And we did not have much deep pockets over there to put in full strength. So this year we are launching it in a full way, and I think that's a very aligned product, because wherever our furniture sells, the cooler are sold, because mostly rural area, and there are only 6 states of operating: Rajasthan, Delhi, Punjab, Haryana, some part of Odisha, and Andhra and Telangana.
Okay. So there is no plan to get into any other household appliances like fridge or a kitchen or anything like that?
At present, we are not looking because we have quite a big basket for the next 2 years. All the verticals and all the product lines where we are thinking we have a good scope of growth. Post 2 years, we would definitely think on some lines which are adjacent to our product, which can add in our company's portfolio.
Right, sir. My second question is on household appliances. So can you give some idea on what will be your growth driver here? Because my understanding is that the market growth is, of course, decent, but it will be like a low double-digit kind of growth here. So is it market share gain from unorganized, or do you see any other organized players which are weak from which you want to gain market share? Or is it a distribution expansion story? What is the driver of the growth here?
So I think, hi, this is Gaurav here. I think on the appliances front, we have a very small base till now. I think, so comparing and taking market share is, still a little far away. As, mentioned that, we are in niche category, and we want to operate in that category. So we look at the appliances and cookware as one complete vertical. And we wish to grow this in the niches that we have spoken about. So we play on our strength, which is our plastic capabilities as well. So we have in-house molds that we are able to, work with. So that differentiates us from the market a little bit. So I think here again, niche is our, mantra, not the mass market.
So just for my understanding, Gaurav, in household products, you have the bottles and the casseroles and all that. You already have a pretty sort of well-diversified product portfolio, and these products have been there in your portfolio since many, many years. So, do you think that product portfolio sort of expansion is the sort of route to growth? Because that doesn't seem to be the case looking at your product portfolio. It is already most of the segments that you would want to be there are already there since many, many years.
No, I think, we have always grown our segment or vertical. Because if you look, we entered into glassware as well. So again, these are all consumer-facing businesses. So glassware was a recent venture, which was only about 5 years ago. So I think that is how we have been increasing horizontally.
I mean, glassware, I understand it's a new venture and there is definitely a ramp up there which is happening. Ex-glassware, the homeware division, I was asking about that.
So glassware is also a part of homeware only. So it is basically one vertical put together because they go to the same household and the buyers are the same. Also the retail outlets are very similar. So I think when we compare as a basket, the whole consumer wear needs to be looked at one vertical rather than, looking at it separately. There will be, of course, product lines which will have saturation at point of time. But then we have always expanded horizontally into different verticals or different product lines. So I think within the consumer wear is a very vast, product array that we offer. And that is why we keep on continually growing horizontally.
Sure. That's all
I
from
hope
me.
that answers your question.
Yeah. Thank you very much, Gaurav.
Thank you. The next question is from the line of Ankur Sharma from HDFC Life. Please go ahead.
Hi, sir. Good morning. Thanks for your time. So while, you said there was a 9% growth overall in the first half, possible to also share numbers for Q2? How would each of these segments, glassware, houseware, pens and the molded furniture, how would each of those have done for Q2? And I understand obviously there would have been a sales shift because of festive. Yeah.
So our consumer wear in Q2 had done around 67% of the revenue. Writing instruments 17% and furniture and allied around 16% of this.
Sure. So I meant on a YOY basis, sir, on a year-on-year basis. I have the.
This year, because we did not have the Q2 figures consolidated, because writing instruments and Wimplas came into the company and got consolidated post-October in the third quarter. So the number are not similar on that line. And because of the time constraints, which I spoke in my first message itself, we could not go back into the index because all the new figures which I am giving are index related and we did not follow index that time. So that's why it is not 100% comparable. And that's why I said it is on the level of 9% growth.
Okay, fair. Understand.
Going forward, definitely we will give quarter on quarter because it got listed on 6th and then going back to the index with when we go index, we have to go with the auditor and it takes a long time. So that's why we took an exemption and from next quarter we'll definitely do that.
Okay. And if I remember your remarks, Q3 seems to be doing reasonably well given sales shifted into October.
So if you see our profit growth, which what we have compared within ourselves on segment is around 20% growth. Going forward, October, because it was the main month for our festive season of sales, we shifted from September last year to October this year.
Yeah.
So this quarter seems, and the last quarter because of the summer season and is very, very robust always, mostly, historically also. So, we think it will be much better than what it is. I think so it should be more than 20% growth over in the second half.
Got that. Okay. I know that. Second, sir, on this new glass, the soda glass factory which is coming up from Q4 in Rajasthan, if you could help us understand, how much sales can we generate from here, what kind of products that will come from here, will margins be similar to the existing glassware business? Just some more color there on the new plant.
Hi. Actually, yeah. So, basically, this will entail this facility that is coming up is about a 25,000 ton capacity. And if we would have capacities of up to 230 crores, that would be the revenue that can be expected from this plant. Overall, yes, margins will be similar lines to our current glassware units.
Okay. And this would be mostly import substitution of existing imports of such glassware, is that right?
Yes, majority of it will be import substitution because there aren't, this is like one of its kind facility in India. So it would be the first of its kind. So mostly import substitution.
Okay. So the market is there. We just need to see the, okay, I understand. Okay. And lastly, sir, on the pens business, I obviously understand, we've had a very long history of, running pens and doing it very well. If you could just help us understand, how do you see this business growing? I know, we've scaled it up very well in the last 2-3 years, but how's the growth trajectory? What are the new products you're looking to introduce, geographic expansion, etc.? Just a few pointers on how you see this segment growing. Yeah, thanks.
Yeah, sure. So I'm Pankaj. I will just give you a brief. So in fact, we started this writing instrument with the new brand Unomax in 2019-20.
Yeah.
And there was a COVID just after 2 months after our launch. But even out of that, in the last 3 years, we have scaled this business from till last year we had done about 285 crores. So from 0 to 285 crores in 3 years. This year, in the first 6 months, have been good months comparatively. And now we are extending our range, as we have already said, that we are mainly concentrating on the gel pen and ball pens. And of course, there are other products with it, but we are going to now getting into more stationery product also, and also increasing our range within the gel pen and the ball pen, which I feel, and even our reach in the market today is much lower because we wanted first to grow because we were growing at a very fast pace. So the capacities and everything would have been constrained. So now we have already put up a second plant, which is already started last year, which has a lot of capacity which will be consumed in this couple of years. We are increasing our distribution network. So we are getting into now more into 2 and 3 tier cities also where we were not before. Our retail network is still very small compared to the size of the market, which we are growing this month. So I think this itself, the overall distribution network, growing the distribution network and the new product, we are very confident that this business for us from this base to grow in a healthy pace for the next 2 to 3 years seem very good. Yeah.
Okay. Okay, sir. Great. Thanks for your time and all the best.
Thank you. The next question is from the line of Pallavi Deshpande from Sameeksha Capital. Please go ahead.
Yes, sir. Just wanted to understand earlier you mentioned about the 20% growth. So that would be for the second half year on year, or you're looking at half on half?
No, so this half, second half.
Second half will be, and so first half was approximately 9% and second half 20%.
Right.
Right. And so secondly, then we would be missing the guidance we had of 20 to 25% for the year.
No, so as I mentioned, because of softening of the price, our price correction was in the range of around 5 to 6%.
Right.
So the raw materials, our major raw material, which is plastic, has gone down by 22%. From February of 23 till April, May, and now further it is softening So the price reduction definitely will have to be passed on to an extent. That's why if you see our gross profit margins have increased in all the sectors.
Right.
So that's why it looks muted. But volume growth, if you see, we will be achieving around 22 to 24%. Though the first half, even the consumer sentiment was not that very high.
Right. Right. And so for going ahead, you maintain that, FY25 onwards at the same 22%.
Yeah. So we are very sure on our profitability figures and everything what we have given. I think so we will definitely achieve that.
Right, sir. Thank you, sir. I'll come back later.
Thank you. The next question is from the line of Mr. Achal Lohade from JM Financial. Please go ahead.
Good morning. Thank you for the opportunity. Sir, just a clarification. You said 9% growth YY for the first half. Is that for the company as a whole or just for the consumer wear business?
For the company as a whole.
And would you be able to give a sense with respect to how much would be for consumer wear and how much would be for the writing instrument and the on the molded furniture?
So molded furniture did not grow in value because there when the raw material goes down by 22%, I think so they have to pass at least 16 to 17%. So in fact, it is a little minus on the value side, though the volume growth is very good over there.
Okay. And what about the consumer wear?
So consumer wear grew at around 7 to 8%.
Okay.
Again, here there is a correction of around 5 to 6% and 1 month shift of our Diwali month being major in October. So last year September was the peak month.
Right.
This year it is October. Writing instruments grow at a healthy 24-25% top line.
Understood. And consumer wear, 7-8% is the value growth for the first half.
Volume growth would be around 13 to 14%. And that too again because of the month
correct.
change to October. Otherwise it would have been in the range of 17-18%.
Okay. And like you said, 20% growth YOY for the second half. Have I understood right?
Yeah.
This second half to second half YOY, right?
Right.
Not compared to first. Okay.
No, second half to second half. YOY.
Sure. Sir, one more question I had, in terms of the margins, and obviously, we have been top-notch in terms of across segments margin performance. Now, how do you see it from here on? Do you see, we expanding margins or, we'll keep margin probably stable and push harder on the growth? How do we look at margins for each of these three verticals?
So margins would be stable. Definitely, we are at a very good level of margins, and I do not really want to comment here we will grow from here. We would be like to maintain. If we compromise also in future, percent or two, definitely that will be only good to take up the growth much higher.
Right. And in terms of the new categories, so you mentioned about the appliances part of it, more so kitchen appliances, if I heard you right.
Right.
Would it come at a substantially lower margin, given it is far more competitive, a lot of existing players being already there for decades? So, is that what you're hinting at when you say, 100 to 200 basis point margin compression only for these new categories? Have I understood right?
So see, this is a very small vertical at present.
Right.
If we do at any margin, it would not affect too much at a consolidated level.
Right.
So for the growth, it is a very small market. We want to grow that. It is at a healthy margin only we want to grow. We do not. That's why we said we really want to go into this area. Though because the expenditures on sales and all are much higher, in this segment, for the time being, we are seeing a little muted percentage of profit. But going forward, I think so we will take to a very healthy level, and we would like to operate on that healthy level margin only.
Right. Understood. With respect to the glassware business, can you help us understand, what is the total industry capacity at the moment? I presume that the utilization has to be 90-100% in order to run it. It has to be run continuously for a couple of years or 3 years. So do you see a risk of price correction, reduction, given if there is a risk of overcapacity in the short term?
Hi. This is Gaurav here. So basically, I think in the glassware side, we operate in two verticals. One is the opalware and the new vertical that is the soda lime glasses, which is coming up in Rajasthan. So on the opalware side, I think the number of players are, few in the market, and not there is a very huge deterrent to entry. And all the three players that are in the market are, good size, more experienced and mature players. So I don't see any problem on that side. When it comes to the soda lime glass, basically it's more of import substitution. So we would be the first ones in India to put a facility of this kind. So I think, and it is still at a very small revenue. So today the market is quite substantial when it comes to imports. So we just want a small pie is what we are eyeing for in that particular market. So I don't see any problems, reaching those revenues in a very short period of time. And profitability, when it comes to the profitability also, we don't see any compromises. There has been expansion of capacities everywhere, even when it comes to opalware. But even after that, the margins seem to be healthy.
Got it. And you mentioned about 13% mix from the value-added products. So A, how do you define this value-added product? And B, this 13%, what is the outlook over next 3 to 5 years? Could it be 25-30%, or could it be more 18-20%?
So this is on the molded furniture side, what we said 13%. Is from our lifestyle products, what we have started last 2 years back, where the product is more valuable. When you see there is a difference, you will definitely see, which can go into households more than being only for outdoors like small eateries and this place, where we get a good price when the product is good. And it's a little difficult to manufacture even out of raw material which is recycled and all, because the strength has to be much better, the looks are different, the colors are different. So this value addition is giving us a better margin. So if you see in Vimplast also in the last 2 years, we have scaled our profitability up in percentage terms compared to any of the peers in this. We aim to take it to 25-30% over the next 2-3 years. The mix of the products, where our lifestyle and better products would be a mix of sale of around 25-30%.
Understood. In terms of the capital expenditure for FY24, I think Atulji mentioned about 225, but how do you see FY25-26? What kind of annual capex would we look at for next 2-3 years?
So if you see, except our glassware, which is a high capex vertical, writing instruments, consumerware, non-glass doesn't have a very high capex. So that we have been expanding over the years. The capex the ratio from capex to turnover is around 7 times. So whatever we want to scale over the next 3 years, if you can see, it will be a very, for the company of this size, it will be a negligible capex, around 40 to 60 crores a year.
Right. So the question that was in mind next was, how do you deploy the cash flows, given the kind of significant cash flows we're looking at annually? How do you see it in terms of dividend or the payout?
See, for next 1 or 2 years, the company we want to use all our money to grow. So the glassware pen plant, when we start, it even needs a lot of working capital. And even if we are aiming to grow at 20% plus CAGR over the next 3 years, our capex, one is the capex side, the other is the working capital side. And we would be looking, if you see historically also, one of our listed company, Vimplast, we have been regularly giving dividend at a good level, and we have maintained that for last 20 years. So Scaling up is too early. We just got out of the issue, and definitely we'll have a policy in place for a really good dividend policy.
Got it. Got it. And just one small clarification, sir, since you raised a topic about working capital. So, obviously our receivables are probably one of the highest in the peers. So, how do you look at this? Do you see utilizing the likes of, channel financing, bill discounting to reduce this, or also curtailing the credit to the trade partners?
A little bit we will curtail. There are some places where we are really giving it high because they are old association with us, and where we were little comfortable. Channel financing, yes, we started a little bit, but we do not want to go fully aggressive on that, because I think so this kind of business and what you see the profitability is because my good products which are slow moving, which do not move very fast, are always they maintain their stock. So the turnaround for that product in their warehouse, also the distributor's warehouse, is a little slow. And that's why the payment is late, otherwise it is not. So if I do not want to sell that kind of product, and I want to sell only Me Too products like everybody sells, the margins get disturbed. So that's why a little bit, from last 25 years, we have been giving a better credit period into the distribution, and that will help the company. So we would not like to really disturb it to a larger extent. Yes, definitely we'll discipline it to a better level.
Got it. Thank you so much, Pradeep ji, for the answers. I can fall back in the queue for further questions. Thank you.
Thank you. The next question is from the line of Yash from Stallion Asset. Please go ahead.
All my questions are answered. Thank you.
Thank you. The next question is from the line of Keyur from ICICI Prudential Life Insurance Company. Please go ahead.
Thank you for the opportunity. The question is on the growth that you mentioned for the second half, 20% growth. That is what you're guiding for the revenue growth, if I'm not wrong, correct?
Right.
So, the way in H1 we have seen that margins are higher because of the lower RM prices. So should we assume that the operating profit and PAT growth would be higher than the revenue growth in the second half? Would be fair to say?
Sure. For at least this 6 months, I'm very sure.
In the second half, right?
Because of the raw material pricing softening up and a little demand being open up in the market, much better than what it was in H1. And now we have the raw material which is fully down. Almost we are at a stage where we are now saturated in going down further, and we have raw material which is already booked. So for the next 6 months, definitely we see whatever we grow, the margins will be above that in percentage of sales.
Okay. Whatever you can share as to how the festive was, the Diwali, if you can share qualitative, quantitative data, that could be helpful. That is second question.
Sorry, I couldn't get your question.
So, post the Q2, in Q3, that is October and November, how was the festive season? If you can share, if you can give idea about how good or bad the festive season was.
Yeah, the festive season, that's what October was a very good month, definitely, and November seems good.
Okay. And just last question, as you start your glassware facility in Q4, now that being a higher margin product, and since we are doing import substitution, so on manufacturing also we'll save some margin, save some cost. So should we assume higher gross or operating margins in FY25 versus FY24?
Sir, once it starts operating in the first year, the entire furnace, which can give us a turnover of around 275 crores plus, will not be achieved, because there are a lot of SKUs, and by the time we launch the locally produced material into the market, it would be around a quarter later. So the depreciation, the EBITDA levels here definitely will be much healthier from this year to next year. But the EBIT level would get over the next 1 or 2 years. Because of that particular thing, we will be operating on other fields, that is definitely there. But because of the glassware, for the time being, I think so we can get a little muted also next year.
In terms of
EBITDA would increase, our depreciation would be very high next year once we start the furnace.
Sure. Understood. Okay. Thanks a lot and all the best.
Thank you. The next question is from the line of Praveen Sahai from PL Capital. Prapudas Liladher, please go ahead.
Thank you for taking my question. First question is related to your CapEx, that is related to the glassware capacity expansion. Just a clarification, total CapEx is of 250 odd crore and capacity would be around 25,000 ton?
No, so the total CapEx would be around 200 crores. 250 is the total layout what we have made over there in Rajasthan. So there would be another product line of the company also being started later on over there. So the CapEx for glassware particularly is 200 crores.
And the potential revenue is 230 odd crore.
275 crores. 250 to 275 depends upon the product mix.
Okay. And second question related to the capacities only. You have a 79% of your revenue in the first half were in-house manufacturing. And if I look at the capacity utilizations for each of your verticals, is like our consumer is more than 80%, writing 68%, and molding is 70%. So how to read this? Like every year you are going for a capacity expansion in each and every vertical, and what level of utilization is the maximum you can go in each vertical?
See, first of all, in writing instruments, it is the capacity utilization was 68 to 70%, whereby we are growing very fast, so that gets adjusted. We just have to add some machines because the mold capacities are already there. Some of the molds, we do add new products into that. Even in a consumer wear, it is just by adding machines. We do not have to create a facility. Unlike the glass, the way it is, you have to put a furnace which is 25,000 tons or a 20,000 tons. You cannot just get in by expansion of 10% more, 10% more. You have to grow, either it is 50 and then 100 and 150. So this is the way the expansion goes in. The utilization also changes a lot because of the raw material pricing. So we normally, when we were given this, we had given this utilization level, it was always based on volumes. So volume is not the parameter what we look normally into our business sense. We look as a value. If this of my unit should make approximately, this is the value of material, it should make in a month. Because we could not give value, the right specification is the value what we can produce. So every plant we have a value-based plant, and in glassware we do on a tonnage basis, how much ton of material we have made in this month and what is our capacity. Except that, actually, the capacity utilization is only on a base historical thought. It is not exactly because the value might change a lot. If I change the raw material from one to another, like if we are making from a PET to a Titan, the raw material price is double. And if I make the similar bottle into that, the machine is same. My value will go double, then 2.5 times of what I was selling the bottle which was made out of another material.
Mm-hmm. Okay.
Being a very low capex on this was never a constraint for the company, and it would not be in future also, except the glassware where we have a higher capex at a time. At one go, we have to do a higher capex to put the plant. In our writing instruments, in our consumer wear other than glass, or in molded furniture, the capex is not very high. So the ratios really do not matter a lot.
Okay. And also similar to your molded furniture business, in which 13% is value-added contribution, can you give for the other segments as well?
Sir, no, molded furniture per se was a lower side. Others, we operate at a very handsome margin only, if you've seen historically. Even in a writing instrument, if you compare last year, our EBIT was around 23%, which was best in the industry, and still we are not at the top peak.
Okay.
So, molded furniture per se, where we really want to go into value-added products, because we were basically, and we have a competition which is unethical because of raw material which is used from recycled material, and that competition we cannot face because it's not apple to apple, right? And that's why we want to shift our portfolio to a category where it cannot be produced from any recycled raw material, or where the brand definitely comes into picture when the price point is very high for a buyer.
Okay. So next question is, so how much is the plastic product contribution in your top line, ex of glass or appliances?
Sir, the reason we have already given, but we have not kept in that way because we have thought it in three verticals only: consumer, stationery, and this. And we have given the gross margins definitely on the consumer wear business.
I think it is, when we compare plastic, we are actually across materials. So, we have product lines where we have a plastic bottle, but we have a steel inside it also. So I think comparing exactly, we are no longer a plastic company. It is very difficult to define the amount of plastic that goes into, because there are glass products with plastic lids. So I think a plastic per se, is very difficult to define anymore.
Okay. Or if you can give how much the appliances contribute to your business?
So appliances today is a very small vertical for us. It's only about 75 crores of the turnover this year will come from that. So it's a very small niche line for us at this point of time.
Okay, 75 crore in FY23.
24.
Okay. So that's the expectation you are saying?
Yeah, that is the overall expectation what we have achieved almost in the first quarter based on that.
Okay, great. And also if you can give some, color on the seasonality of each of the products. Like as you mentioned, overall second half is expected to deliver a very high growth, higher compared to the Q1. And also you had highlighted that October is on the, heavy month, which shifted because of festival. So is each verticals, if you can give some, how is the seasonality throughout in a year?
So I'll start with the writing instrument with the easiest. Back to school time is a little higher scaling up and exam time. So January, February, March quarter will be a little higher. April, May, June also. June, July, April, May, June, right? April, May, June.
April is low.
April is low, May, June are very high months, so that quarter is good. Going into our consumer wear business, definitely festive season gives a spike of around 4 to 6%. So if in the 12 months, if I divide 8.33, I think so our Diwali 2 months period would give us 1 to 22% sale. Other than that, it's not very strong seasonality. Summer we have a spike because of bottles and water jugs, because it's a longer season. It's almost 2.5, 3 months. And back to school also falls into the same.
Okay, great.
We don't have a very high seasonality where the sales come to 5% and then go to 15% in the second month.
Okay, sir. And the question on the distribution, as you also mentioned, and in your presentation, general trade contributes on the higher side, 75-76%. Way forward, we are going to maintain such kind of numbers, or we are expecting modern trade and etc. to contribute more?
So as the modern trade traction is also again now getting established, if you see, there were very few retail companies in India. One of the biggest which could not sustain and got closed. Okay, and so now again it is getting up. Earlier modern trade had a problem of pricing always, and now they have understood the game also. Okay, even we need some brands. Without pricing, with only pricing, will not be able to be a good store. So the metrics will definitely change. Our general trade over the next 2-3 years would be around 70%. Our online sales will go from 9-10% of what it is today to around 12-13%, and similar from 5% of our modern trade will go to 7-8%. Our export will be from 8-9% to around 10-11%. That's what is the basket what we are looking at over the next 3 years.
Okay. And just lastly, sir, on one clarification on the license for 20 years. Can you elaborate further, like how much the amount is and how this structure is actually?
So it is owned, the brand is registered in one of our partnership companies, where the promoters are 100% partners over there. We have licensed this from Cello Plastic Industrial Works to our company for 20 years was the first thing, and perpetually it can be automatic renewable. None of the consumer space, it is an exclusive license with Cello World Limited, and none of the consumer items can be even manufactured by the promoters who own the brand as a separate company outside the company. There is no royalty, and it is an auto renewable, so you can assume that it is a perpetual license which you have got for consumer spaces across.
And how much amount paid for this?
No, we have not paid anything.
Okay. So there is no outgo of money, but we are having for 20 years, and that will auto renewal.
Yeah.
No. Thank you, and all the best, sir.
Thank you.
Thank you. The next question is from the line of Jagveer Singh from Shade Capital. Please go ahead.
Yes, sir. Thanks for the opportunity. And my first question is related to the writing instruments. So we have done an amazing work from 0 to around 300 crore in 4-5 years when we launched Unimax. So how much we are doing from exports and how much is the domestic? And how big is the export opportunity for Indian players?
Yeah. So we are now almost 4 years after launching the new brand, Unimax, from 2020. Last year, we had a turnover of 285 crores. Out of that, 40% was export and 60% was domestic. And I feel even in this year, I think it will be 35% would be export and 65% will be domestic. Henceforward, we feel that maybe we will have a 30-70 ratio going forward.
But how big is the export opportunity? Is there anything like China plus one in the writing instrument?
What? I didn't get it. Hello? Yeah, I didn't get you the last, what you said?
How big is this export opportunity? Is there anything like China plus one in this writing instrument?
You mean to say the numbers, what we did last year or this year? What is the size of the market?
Yeah, so how big is the opportunity for Indian players for the export?
The size of the market is huge because if you see the world market, it's like, it can be like a 40,000-50,000 crore market all over the world is writing instrument. So we are just a very small part of it. So it's about 150 crore export, maybe this year 40-50 crore is very negligible. So there is a lot of potential of growing in this market here.
Okay, so Clear is a big company in the writing instrument doing around 1,000 crores of revenues.
Sorry to interrupt, Mr. Singh. Is it possible for you to use the handset mode? But there is an echo coming from your side.
Yeah.
Hello?
Yeah.
Much better.
Now it's clear, sir?
Yes.
So, sir, in the writing instruments, Clear is a big company doing around 1,000 crores of their revenue. Even then, our margins are higher than the Clear. So, what is the main reason? Because we have more exports, so lower advertising cost, or what is the reason for this?
No. So we are basically, we operate in a category which is above 10. We don't do below 10. So this is one of the reason, and also we are also like have our product mix and our pricings are better than the competitors. because we add more value products instead of getting into those lower end volume products. Yeah.
And in the opalware side, largest and the oldest player have a very high EBITDA margin, around more than 40%. So our opalware business also can do at some point these kind of margins, or we have aspiration of these kind of margins in the opalware business?
I think we already do similar margins to our competitors. So I think we're not far away from that anyways.
Okay. Is there any thought on the merger of this Bimplast business? Because now we have two listed companies, so any thought on this merger?
So over the time, we will definitely think and consider that.
Okay. The last question, sir. We did two things in the last 4-5 years, and one is the writing instrument. So we have done a 0 to around 300 crore, and second is the opalware. So we have all 2 years we have did very good, very good. So any other product lines where we can do these kind of new category where we can do this kind of scale?
So see, first of all, a new plant for glassware is coming up. Though it is a glass, opal glass and that glass, but it's completely different at end use. So that has a huge potential, and I think so for the verticals what we have at present has huge potential over years. For the next 2 years, the glass plant and opal expansion and writing expansion will like to concentrate much more on that to become the top level plant. And porcelain is one project which is coming up, which is almost due to be launched in January, where we will have more of hot drink wares and dinnerware.
Okay.
I think the company has a lot of verticals which we have already started in the last 3 to 5 years, and which needs to be scaled up. So we have a lot in our basket already to perform and to consolidate that on a higher level and maintain our profitability or grow from here.
Okay, sir. Thanks a lot, sir. Thanks a lot for the opportunity.
Thank you. The next question is from the line of Karan Bhatelia from Asian Market Securities. Please go ahead.
Hi, thanks for the opportunity and congrats for a good set of numbers. Am I audible?
Yes. Yeah, sure.
Yeah. Sir, how is the capacity ramp up going with respect to our expanded capacities on the opalware as of now?
So opalware, we have already expanded our capacity. It was done recently in August of 2024. So it's now in full capacity mode.
Right. So we seeing the benefits already on volumes and on profitability side, or we need to see the full benefits?
So we have seen already, but I think it will be even it'll be better in the next coming H2.
Right. Thanks for that. And also with respect to our Rajasthan facility, we'll be having 20,000 metric tons. So do we have sufficient land parcel if we have to further expand that, if the demand for glassware, increases all of a sudden? So do we have enough land parcel at Rajasthan for glassware and for opalware at Daman?
So I think we have yes, we have a pretty big land parcel. So all our expansion, whether it be glassware, plasticware, anything, for the next 5 to 6 years, we have enough land parcel to grow all our verticals.
Right. And you did mention of a 20% kind of value growth on second half to second half. But any color on how with respect to first half and second half growth, like a second half growth on the basis of first half, what's the outlook over there? Because we don't have second half numbers of last year.
So if you see the first half of this year, we have done around 960 crores.
Right.
Full year last year was 1796.
Right.
So I think so it would be clear from the historical and what we have achieved over here, how would the second half look if we are assuming to grow at 20%.
Right. Okay. That's it for a man. Thank you.
Thank you. The next question is from the line of Dipesh Sancheti from Manya Finance. Please go ahead.
Yeah, hi. Am I audible?
Yes, sir, you're audible.
Okay. Congratulations on the IPO and the strong listing. Just one question about going ahead, what will be the growth drivers? Will the expansion coming from glassware and Rajasthan will be the only growth driver, or there will be an enhanced capacity utilization as well as CapEx in other consumer wear, writing instruments and molded furniture?
So definitely we want to scale up in all, as we already mentioned, writing instruments is a small vertical which we started 3.5 years back, right? And that has a lot of expansion, and we have already created new capacities within writing instruments. Our consumer wear, glassware and opalware, plus the other products which are the main line of the company, insulated wares and all, we would definitely grow at a healthy pace in that also. Glassware could be a major driver. Writing instruments also can be a major driver to that. But our other consumer products also would grow at a very healthy pace. So when we are assuming a 20%, it won't be much different in those times.
So going ahead in FY25, we will be growing at a faster rate because of the glassware also coming into the sales.
Yes, definitely. It will help further grow the numbers.
Fine. And just one question about now Cello World, we are getting at a price to earnings at around 60, whereas our subsidiary Webglass is getting a price to earnings at 15. Now a merger will actually enhance the value for the company as well as for shareholders. Has the management thought about the prospect, because this will also help you reduce your shareholding to below 75%?
No, definitely, we will look. Earlier also I answered this question. We will at the right time definitely would like to do that. But I think so it would be unfair to comment, or I don't think so exactly I can give you the details on this call particularly.
Okay.
Once we have the approval of the shareholders and all, we will definitely look into that.
Okay, sir. Thank you so much, and congratulations again. Take care.
Thank you.
Thank you. The next question is from the line of Manav Vijay from Deep Financial Consultants Private Limited. Please go ahead.
Yes, thank you very much, sir, for the opportunity. So my first question is regarding the writing instruments division that you have. Could you please mention what is the capacity that you have and what is the utilization that you are doing right now over there?
Yeah, so last year we did a turnover of 285 crore in writing instruments. We have a capacity which we put over last year with the second plant is about, in terms of it's almost 550 crore volume we can do. So I think there will be good enough for the next couple of years, yes. 3 years.
Okay, so that means...
So we have already started the second one, so the capacity is not a problem. We even at a grow at a healthy problem, yeah.
Okay, so on the current plant capacity that you have, you can do around 550 crores of sales, and
yes.
There is no further CapEx.
Yes. We have to just add some more machines, that's all. The land and everything, building and all the other products all are in line. Just some more new machines will be added as and where the growth is every year.
Okay. So second question is regarding this segment only. In response to one of the earlier question where the difference between the gross margin and the EBITDA margin was asked by one of the earlier participants, it was mentioned that we do not operate under actually rupees 10 price point, and that is why we have the average the margin is actually slightly better. So for us, what is our average selling price that we realize at the company level?
So the minimum MRP of the product is 10 rupees, and it goes to, say, a metal pens which are almost 200 rupees. Also, it's a difference is that we always choose the product, even in a category, to be commanding a better price because of our quality and because of our product demand. So even on it's not just the MRP, but also our net realization to the competitor is higher. We operate in a more innovative way in terms of the distribution, which gives us a better margin. Second is also we don't operate into a lot of categories, like say there can be a very example, there can be a sketch pen which can be sold at 12 rupees for 12 pens, but we are selling a coloring pen at about 150 rupees for the same product. So it all depends on the product what we say. So we are going with a more profitable business than just putting numbers. After that also we have a strong market to grow in this category. So like in the last 3 years, you can understand that we have scaled up this business from 0 to say 285, and we have this quarter, this 6 months also we have grown very healthy. So I don't see that we want to grow at a more value-added product rather than being on a just a mass market where we don't feel any value.
Okay. So is it possible to share the average selling price that you realize at the company level?
Yeah, it's almost like average 6.5 to 7 rupees per piece. Net realization. Yeah, 6.5. Yeah, because maximum is 10 rupees and then above, so it will be like somewhere at about 6 rupees or something. 6.50. Yeah.
Okay, sir. My second question is regarding the opalware, let's say so the expansion that you have done. So after the expansion, what is our total capacity? And on that capacity, what is the sales maximum possible that you can do?
So I think we expanded our capacity by about 10,000 tons, and the maximum the total sale that is possible now is in the range of 400 to 425 crores, is what we expect from this plant.
Okay. And at this kind of a sales, what are the gross margins and the EBITDA margins that are possible?
So we have already given the segment, so the EBITDA margin would be in the range of around 27% to 28%.
Okay, and the gross margins of around 53-54%.
So the gross margin, particularly in opalware, is different. So we have given at the consumer level or at a consolidated level of 53%.
Okay. Sir, maybe just one confusion that I have regarding your consumer wear division. So over there you have opalware, you have appliances, and you have other kitchen instruments. Glass is not there as of now.
Vacuum blast, yeah.
Glass is there?
No. Vacuum blast, steel vacuum blast, normal vacuum blast, lunch carriers, buckets to storage containers. There are many vertical end use I think more than anything you can have. So there are a lot of products in that. That is our resilient business. Hello.
Okay.
I hope you wanted this. Was it on the same line what you asked?
So what I want to ask you is that in your current consumer wear segment, you have opalware and you have appliances and you have so what you do not have is the glass.
No, so glass to an extent of import is already built in the opalware business, because we started importing a little bit glass to have the feel of the market before we were putting the plant.
Sure.
What are the products, and that's what we started importing just to have the feel of what are the products we should manufacture when we start this plant. Because mold, plant is one, and then what type of product, every product has to have a different mold and the design and all, so we have to make the molds. So we wanted to have the feel, so we started importing to a small basket, what we did over the last 2 years, and then we will convert that into our production locally.
Okay. My last question is regarding, sir, in glassware, you mentioned that you're putting up this capacity, and this capacity can do around 250 to actually 275 crores of sales. What do you think is possible in terms of in how much timeline you can reach to this desired sales number?
Right. Hi. So basically, these numbers, it's a continuous plant, and I think we have sorted in that aspect. So at maximum in 1 to 2 years, 2 to 2.5 years, we should achieve that number.
Okay. So Gaurav, I think since this will be a continuous process, so you will run the plant actually at full capacity, and you will continue to build the inventory till the time you will have the desired market. Would that be the right assumption to make?
Yeah, that's correct.
Okay. And at that full capacity, what kind of margins are possible?
So we're looking at similar margins as we have in opalware.
Okay, perfect. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Pallavi Deshpande from Sameeksha Capital. Please go ahead.
I just wanted to understand two things. What would be the glass revenues in first half for us within consumer wear, 633 crores there. And second would be, what would be Milton's capacity on the glass side, soda lime glass?
Milton is not manufacturing any soda lime glass.
No.
He is 100% on import base. So I don't know what are the figures accordingly.
And these lunch boxes, they use the soda lime glass, right?
Who?
The lunch boxes, they use the soda lime glass, is that right?
No, soda lime is in vertical. In soda lime is basically, you can say, a name. So normally it is drinkware, containers and everything what comes out of it at the end product.
Right. Yes.
So soda lime is a material name.
Right. Got it. And so what would be our revenues in the first half from glass division?
No, so it is there in the consumer wear completely because from a little competitive edge, we are only giving at the gross margin levels. Because we see all our businesses are consumer-based business, as we earlier strategized in that way. Some of the figures definitely I can discuss with you on this, but we do not want to report into segment reporting. It gives a lot of insight of the company to the competitors.
Right. Got it. Thank you, sir.
Thank you. The next question is from the line of C.A. Arun Maruti from Shubh Labh Research. Please go ahead.
Yeah. Am I audible?
Yeah.
Congratulations for the good listing and thanks for the opportunity, sir. My question is with regard to the borrowing which we show in the balance sheet, that we have a good amount of loan from the related party. So some color on that going forward will be very helpful.
So related party was all the when we consolidated all our companies into Cello World, the promoter sold their partnership companies into Cello World and what is the switch? And so the money required by the company, I think so, which I have explained again, it is a loan which is created by the transfer of asset, which will be paid back to the promoters in next 3 to 5 years as the cash flow of the company happens.
Okay. And on the opalware capacity side, if you can share the current capacity utilization, sir, on that.
So we've just expanded our capacity in August of 2024. And basically 23, sorry. And we basically currently are at 60% capacity utilization.
Okay. And what is the expected timeline for the utilization of the 100%?
About 1.5 years, we should be completely utilizing the entire capacity.
Okay, that's great, sir. And on the marketing spend side, as we have the brand ambassador, Mr. Amit G. So, what is the duration of that contract and what are our standard marketing spend percentage of revenue and going ahead? Yeah.
So Amitabh Bachchan contract is we renew every couple of years because he has this thing that he renews the agreement every year. Our normal, all the production and all the advertising, TVC is all being made, and whenever we require, we will use him again. But our contract is like automatic renewal every year.
And what is the sustainable, the percentage of marketing spend of the revenue?
2%. With this kind of volume, 2.5% would be a good size of
and going ahead also it will remain same?
Yeah.
Okay. And on the online sale, if you can share the number, what % of sale we are getting from the e-commerce?
So currently we are doing 8% of our revenues from our online business, which we are, trying to scale it up to about 10 to 12%.
Okay. Thank you, sir. That's it from us.
Thank you.
Thank you. The last question is from the line of Karan Bhatia from Asian Market Securities. Please go ahead.
Sir, you did mention of getting more aggressive on the stationery wear side of the business. So if our realization on pens is 6.5 rupees, what could be the average realization for stationery wear and how it can change the blended margin profile going ahead?
So stationery will be a little depend on what kind of stationery. So children's stationery, the market, the price points are a little higher. So maybe the average realization, but that still compared to our business, we still feel that our writing instrument will be 70% of our business in future, and 30% would be stationery. So even if the stationery product prices are higher, maybe in terms of the changes in terms of per product realization will improve every year, because we are also adding more value products. So we are adding more about 10 rupees, like 20, 30, 50. All these ranges, so maybe the price point will move up in future. So maybe that's the whole idea of getting into higher end product. Major volume will come from the mass product, but on the 10 rupees product. But definitely we are moving towards higher price point.
Right. And with respect to margins, are they substantially better compared to the writing division, or it's almost at par?
So we are almost at par, yes.
No, sir, going ahead, I'm saying.
Yeah, so we are already at a very healthy margin. So maybe we'll continue this thing.
Right. And with respect to domestic export, it will be again 70-30, or the stationery will be more on the domestic side?
30% will be export and 70% will be domestic. For the next 2-3 years, this is what we are looking at here.
Okay. Thank you for this clarification.
Thank you. As there are no further questions, I would now like to hand the conference over to the management for closing comments.
Thank you everyone for joining today's call. I hope that we were able to answer your questions satisfactorily. If you have any further queries, please contact SJ, our investor advisor, the relation advisor. Thank you, and thank you to all.
Thank you. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.